So value for money is typically about return. So there is a financial value that investors get in return for paying the cost and taking the risk of investing with an investment manager. That's the main way, but it's not the only way. So if you're an investor, you might be getting advice, or you might be getting other things that you value. So what we've said in the guidance is that if it's not financial returns, then in order to charge for it, or in order to say that it represents value for money, that it either has to help your member make a better decision, or it has to demonstrably benefit their account. So that would be something like a solid investment process where the manager can show that it reduces the risk or enhances the return, or both, of the member's account. So the guidance asks providers to put a real discipline around what we think they should be doing anyway, and that is an annual review of their fees and of the value that they provide to their investors in return, which has to involve their supervisor, and it has to be evidence to us. So we have to see that they've actually done it. And there can be two outcomes from that. One is that they have an official conclusion at the end of that review that their fees are okay and that they do represent value for money, or if not, there's some concrete steps are taken to address that, which can include add more services, so add more value so they get more for their money, investors get more for their money, reduce the fees, both, or something else which makes a proper difference. Two things for investors out of this. One is they should get greater confidence that their manager is going through the type of process they probably would have expected them to have done anyway. And if that process concludes that maybe the fees are a little high, or maybe the value isn't there for it, they get good valuating services in addition at no extra cost, or their fees are reduced, or both, or some other concrete steps to recognise that the balance between fees and value for money isn't quite right. Supervisors are independent, and what they are actually is the front line of supervision of KiwiSaver schemes and of non-KiwiSaver managed investment schemes. The guidance says that their role is to make sure that this annual review happens, and not only just an annual review as well, but if there's a change in strategy or there's a change in underlying managers which might impact cost. Aside from guidance, we can issue stop orders, we can issue direction orders, we can alter or remove the license, which means stop operating, and we could even take court action. It all comes back to the statutory responsibility to act in members' interests, and we can take action if it's clear that they're not.